Okay, learning objective 4 takes us through the preparation of the financial budgets for a manufacturing organization. And once again, to see how this might be applicable to all of you, even though you may never become an accountant, the operating budget is something that managers, supervisors, and organizational leaders are going to be involved in as far as determining what the strategic objectives are for their particular division or area and how those impact the organization as a whole. So the things that you have just seen about the operating budget are things that you may have simply as managers or supervisors direct hands-on experience with. And once you have provided that information to the chief financial officer, the plant controller, or the chief executive officer, they're going to utilize those tools and supporting documents that you have provided in the operating budgets to begin to prepare the budgeted financial statements. And remember, those are the income statement, the balance sheet, and the statement of cash flows. So before we can begin the production of those budgeted in preparation of those budgeted financial statements, we have to take into consideration the capital expenditures budget. At this point, we've only seen operations, so day-to-day operations. Now we're going to look at how some of those items that are in the strategic budget impact what's going to happen to us this year. So the strategic budget was long-term, but in the long-term planning, there were different types of purchases or expansions or acquisitions that are going to take place each year. What are those? So are we purchasing, for example, delivery trucks, computer systems? Do I need a new database, office furniture? Am I upgrading manufacturing equipment or purchasing new manufacturing equipment? So we've got to take the capital expenditures budget into consideration along with the operating budget that we just prepared. Once we know the cash that we're going to spend on capital expenditures, we can begin to prepare the cash budget. So we're going to get information from the operating budget and the capital expenditures budget. We'll look at cash receipts, cash payments, and short-term financing. So for example, in this first illustration of cash receipts, we're looking at, let me grab a highlighter here for you. We're looking at cash receipts from our customers. Okay, so in most cases, this is where our cash receipts would come from unless we are borrowing, and we'll see that in short-term financing. But notice for customers, your book tells you that 30% of your sales each quarter are anticipated to be cash sales. So if I have $75,000 in cash sales, I have $75,000 in cash. Okay, so that is cash collected. Now, it tells us that we're going to have 70% of our sales are going to be on credit. So when we generate the sale, we generate an account receivable and not necessarily cash. So out of those credit sales, out of the 70% of our sales that are credit sales, 60% are collected in the first quarter and 40% will be collected in the following quarter or the second quarter. So first quarter sales, I'm going to collect all of the cash sales. I'm going to collect 60% of my credit sales, and in quarter two, I will collect 40% of quarter one's sales. So we see that here. Okay, so even though they were sales in quarter one, they ended up being cash in quarter two. Okay, so it walks us all the way through, and we can determine our accounts receivable as well using this budget, because if I know that, once again, that 70% of my sales are credit sales and 60% are going to be collected in the quarter of the sale, then in my fourth quarter, I still have 40% of my sales that will not be collected until 2020, so I will be left with $91,000 in accounts receivable. These are estimates. Okay, realize these are estimates, but your estimates are only as good as your budgeting process, and your budgeting process is only as good as your estimates. Okay, so this needs to be as precise as possible. So then we have cash payments. What did we spend on capital expenditures? That's pretty basic, but what about our product cost? What did we spend on materials, on labor, on overhead, and selling and administrative expenses? So once again, we have an illustration here, and with our direct materials, because you're purchasing lots of direct materials, you're typically purchasing on credit. So for example, when I worked with a manufacturing organization, we purchased lots of steel. And so we might purchase $600,000 worth of steel at one time, but we would pay for that 90 days later. Okay, so in this case, it's telling us that we pay for 75% of our purchases in the month or the quarter that they actually take place. And then we're going to pay for 25% of those purchases in the following quarter. Okay, so all of these, the $48,000 and the $16,000, were the cost of my materials for quarter one. But as far as they're related to cash, I spent 75% of that cash in the first quarter and 25% of that cash in the second quarter. Okay, so we see that take place with our raw materials every quarter. But what about direct labor? Okay, most of the time, our people who are performing direct labor want to be paid immediately. And so we see labor costs taking place in the quarter. So we're actually spending cash on labor when that labor is incurred. And the same thing with manufacturing overhead. Your book assumes that you are paying for it when it happens. Selling and administrative expenses, once again, your book is assuming that you are paying for these expenses in the period that they actually take place. So now we have income taxes. Okay, so what about income taxes? We've estimated $70,000. But most organizations, especially even large organizations, are required to make installments of their taxes throughout the year. And so if the organization is paying, in this particular case, it just said, if we know that we're going to owe $70,000, we're estimating taxes of $70,000, let's just pay a fourth of that in each quarter. So we see those taxes spread out over each quarter. Our capital expenditures said that we were going to pay for part of those in the first quarter, part of those in the second quarter. So we see those expenses taking place, or those cash outflows taking place here. Okay, so we can come up with a total cash outflow, cash payments, okay, for our organization using the short-term financing or the schedule of cash payments budget. And once again, we can also determine what our accounts payable balance is going to be simply with our direct materials. We know that we paid for 75% of those in the fourth quarter, but 25% of those fourth quarter purchases will not be paid until next year, leaving us with accounts payable of $25,500. So once again, you can see how using an Excel spreadsheet can make this process so much more expedient, accurate, and give us some flexibility to change some things. So if our 75-25% ratio changes, we can simply change it here and adjust what those cash distributions are going to be. All right, short-term financing, what are we talking about here? Most organizations want to maintain a certain or minimum amount of cash for operating activities every period. Now, hopefully we're generating enough cash from operating activities to sustain the organization. But what if we are an organization that is seasonal and we generate a lot of cash flow in the seasonal months and we generate less cash flow in the off season? Then we can't just pay our people in the busy months or pay for our supplies in the busy month. We have to maintain enough cash flows for operating activities. So your book says for Smart Touch Learning, they want to maintain a minimum cash balance of $30,000 at the end of each quarter. So if we look at the first quarter, we have our beginning cash balance, which came from that balance sheet for the end of 2018. We've calculated our cash receipts. We've calculated our cash payments. And so what we find out in the first quarter is that we spent more cash than we received. We have a deficit in cash of $15,715. So in order to get the $30,000 balance that we want to maintain, we're going to have to borrow. Okay, so what happens, usually an organization will have a revolving line of credit with a bank, and at any time they can draw against that revolving line of credit, but at any time the bank can call that loan back. Okay, so it's basically, as we say, a line of credit. that is available. So we're going to hit that line of credit for $45,715 in order to get my beginning balance for cash up to the $30,000 that's required. Your book says we're going to do that in increments of 1,000, so we end up with $30,285. We go through the same procedures in the second quarter, and what we find is that this quarter, I end up with a deficit of cash of $11,010. Okay, so once again, we've had a quarter where we spent more cash than we received. So in order to get to the $30,000 balance that I need, I'm going to have to borrow. So we borrow $42,000 to get our beginning cash balance up to $30,990. Let's see what happens in the next quarter. We know our cash receipts. We know our cash payments, and finally in the third quarter we've had a very liquid quarter. Now I have $77,335 in cash, and I only want to maintain a minimum balance of $30,000. So what are we going to do with the excess? We're going to begin paying off that revolving line of credit that we've tapped into. Okay, so it gets us back to a beginning cash balance of $30,000, receipts, disbursements. Once again, in the fourth quarter, I've had a very lucrative month. I have $90,590 more in cash receipts than I had in cash disbursements. So what can I do? We will once again pay off the remaining balance that we have borrowed. And this gets us down to our totals for our cash budget. And we have the beginning cash balance for the balance sheet, we have the ending cash balance for the balance sheet, and we have the information that we will need for our statement of cash flows here. Right, so we have all of the information from the operating budget, the capital expenditures budget, and the cash budget to begin preparing our budgeted financial statements. The income statement, and you're more than welcome to flip back through your book and see these illustrations, but our income statement needed sales. It comes from our sales budget. We need cost of goods sold. It came from our cost of goods sold budget. Selling administrative the same way. There were some interest expenses and some income tax expenses. Those were calculated on our cash budget. So now I have the information that I need to prepare my budgeted income statement. And the net income that my company is generating is going to become retained earnings in my balance sheet. So now I can prepare that balance sheet. I have the cash amounts from the beginning of the year. I have the receivables from my cash budget, the raw materials and finished goods inventory from my raw materials budgets. I have the property, plant, and equipment from the prior year balance sheet plus the equipment that I was going to purchase, and we've calculated depreciation. We know accounts payables from our cash disbursement budget. We know retained earnings from the beginning retained earnings on my beginning balance sheet plus the net income. Stockholders' equity hasn't changed. Okay, they haven't told us about, or well, let's just say our common stock hasn't changed. Our stockholders' equity will, because retained earnings go up. But we have all the information now that we need for our balance sheet, and now that I have beginning and ending cash, I can do my statement of cash flows. And all of these numbers are coming basically from my cash budget. Okay, so once again, the information that you may be providing as a manager or a supervisor is the information that ultimately derives what's going to happen in your company's budgeted financial statements. And we can use technology to make this process so much more efficient simply by using a database or an Excel spreadsheet. We can change numbers in that spreadsheet to do a sensitivity analysis. We can combine, if we're manufacturing and selling multiple products, we can combine those products from the individual worksheets to one worksheet that includes all of our products. Okay, so, or if you're a governmental organization, you're the state of Tennessee, and you have budgets coming in from all the different operations and divisions within the state, we can combine those into one large master budget easily using technology and databases and Excel. Okay, so we're going to stop with the the learning objectives 4 and 5. If you want to look at more information that is related to the preparation of your budgets for a merchandising company, please feel free to do so. But once again, the primary difference is the cost of your inventory. So for a merchandising company, we're simply buying for resale. So it should be a lot less complicated and complex than the manufacturing organization, where we're actually calculating the cost of material, labor, and overhead. So feel free to review this if you would stop, but I will not hold you accountable for the operating budget of a merchandising company on your next exam.